Hello everyone and welcome along to another month, another webinar. It is so good to be here at Property Live. Now, I always like to do just a little bit of a sound check before we get going. Now, I usually ask what colour Andrew's shirt is. I'm going to change it. What colour is my drink?
I want to ask
No,
it.
I've already asked it now.
No. My question is, do you like Ed in the t-shirt so he can show off his muscles?
That's not what it is.
Yeah,
I'll tell you what
it
it
is.
actually is. The reason why I'm
echo.
little echo. Okay, we'll see if we could fix that. Beer colour, yep.
Buff!
Oh,
Yes.
I'll take that.
Oh my God, I'm sorry I asked.
The reason though, the real reason that I'm wearing a t-shirt today is I go back and forth from Auckland and Christchurch. I fly down to Christchurch every week because I live in Auckland, and I was packing away and I suddenly got to Christchurch airport last night and realised I don't have any shirts on me. So I'd completely messed it up, so I'm in my gym gear to some degree.
There are shirts hanging over here and he's decided to ignore them to show off his guns.
Okay. Well, we'll pretend that's correct. Now, we're going to have a great night tonight. We're specifically going to dig into the property market and give you guys a really robust update. And the thing is, there's been so many changes over the last month in the property market, from tax announcements all the way through to new data about listings and sales. And I really want to crunch it so we can zoom out and understand where exactly are we in the property cycle right now. We're going to have a lot of fun while we do it. So let's just jump straight in. What are you giggling about?
Some of these comments.
Whoa, you're just nattering away.
Welcome to the gun show. I particularly enjoyed.
Okay, bang, bang. Now, it is important to mention that this is a webinar. It's not personal financial advice. So while we'll give you some ideas about what you might like to do as a property investor, we're not telling you specifically to go away and do this thing. Ultimately, that's up for you to decide or to talk about with a financial advisor. The really cool thing is there are lots of new faces here tonight. In fact, this number has crept up over the last couple of hours. There are over 2,200 people registered to come tonight. We'll definitely get several hundred of you along. And that really means that we can create this community, this Opus Partners community, where you guys are free to talk about property investment down there in the chat, and we can talk about property in a really safe space. I think it's really awesome that we have these every single month. But if you are here tonight and you've never met us before, you might be thinking, well, why should I listen to these two jokers? If you don't know us, we run New Zealand's #1 business podcast. It's called the Property Academy, and we release a new podcast every single day. And I'm so proud to announce tonight we have just ticked over 8 million downloads of that podcast over the last 5 years. And I'm so grateful to every single one of you who has even downloaded once for 30 seconds. So thank you, Mum. I know you do it, because together, you guys listening to the show, that adds up to those 8 million, and we're just so proud of it. So thank you for being part of the community. We've done so far over 1,600 podcasts, over 50 of these webinars. We own New Zealand Property Investor magazine. Some of you guys might read that, and our book is currently in bookstores. My name's Ed. I'm an economist at Opus Partners, and I invest in property. And my colleague Andrew, he's a financial advisor, managing director at Opus Partners, and he's a property investor as well. Now, Andrew, there are some things we're going to give people tonight. You get the webinar for free. It is being recorded. People are going to ask it in 20 minutes, half an hour, 15 minutes, right throughout the webinar. If you see somebody ask that if they come in late, yes, this is being recorded. We'll send it out to you, early afternoon tomorrow, and we're going to do a Q&A at the end. So make sure you stick around, because those are some of that's some of the most interesting stuff we talk about at these webinars. Now, Andrew, there's something very near and dear to your heart, I know.
How many of these have we done? About 50?
We've done well over 50 now.
There's just, we always get questions in the chat. Now, that's awesome that you guys are chatting in the chat, but the problem is Ed and I want to answer as many of them as we can at the end. So if you've got a question, put it in the Q&A section so we can guarantee that we can answer it at the end. Otherwise, though, focus on chat for chatting amongst yourselves, and to make sure that everyone gets the most benefit out of tonight, make sure you put your chat to everyone so it's not just Ed and I that you see.
Because otherwise, Andrew and I are going to chat back and forth throughout this webinar. We might not see everything you see, everything you say. So if you send it just to hosts and panelists, we're not going to see it. There's a good chance we'll miss it. Send it to everyone. There's going to be a couple of hundred property investors to talk back and forth with.
Before we go any further, haven't you got a special welcome?
What was my special welcome? Oh, yes, sorry. I forgot what the special welcome is.
I remembered.
So it turns out, I might mess it up. So it turns out my parents-in-law, or soon-to-be parents-in-law, are here tonight. And as we say in Korea, 안녕 하세요. So welcome. It's so good to see you here this evening. You made me all nervous.
Look, you're blushing.
I am. I've got readers my drink. So we're going to have a very fun thing today. We're going to do...
We're going on tour.
We're going on tour. We're going to do the property market update a little bit different to where we have in the past. So we're going to tour around 5 different locations to gather data to better understand the New Zealand property market. And we're going to start at the Real Estate Institute of New Zealand before we tour around New Zealand. So we are starting here in Auckland, which is where the Rhines office is. And Andrew, one of the things we've been getting questions about, especially on YouTube, is have property prices really bottomed out?
And I think that's a fair question because everyone wants to buy at the bottom of the market, but there's pros and cons about investing in any part of the market. If you're buying, as the market's skyrocketing, then hopefully you get some instant growth. But if you're buying when it's bottoming out, it can often be a bit more scary. So if you think about the peak of the market, it's the wrong one. If you think about the peak of the market in November 2021, from there to the bottom of the market, the property prices fell 18%.
About 18%.
About 18%. That's massive. Has there been any drop that significant or that higher percentage in as much data as we can get?
Not in New Zealand, not since 1992 when Ryan started releasing data. The next largest fall was about 8 to 10%, which was back in the GFC 2008.
And look, we've seen the start of a recovery, and obviously you can see there that January's been a little bit slower. It hasn't been, the market hasn't taken off at the start of this year, but absolutely we believe that property prices have absolutely bottomed out.
Yeah, they're about up 4.1% since May 2023. So over the last 7 months, we've seen a bit of a recovery. Took a little hit in December, but that's what we usually see in December. So there's just a bit of seasonality in there. But property prices have bottomed out. But one thing that's really important is it does depend on exactly where you bought. So we've got people here all around the country, and I want you to go to your chat in a minute and tell me what data you want to see, because Andrew, you're going to read it out to me, and I want to show you this specific graph here. So here I've got house prices all around the country. I'm going to make this nice and big for you.
Show us the dark red one there, Ed.
Okay, so that is Wairoa district. So that is in the North Hawke's Bay, and house prices have fallen 32.8%
Okay,
there.
a lot of Christchurch in there.
Okay, down in Christchurch, we haven't seen property prices fall as much. So currently, house prices in Christchurch are 6.3% below where they were at the peak. So they peaked in February 2022, they bottomed out in June 2023. They actually, in total, fell about 11%, but you can see they've bounced back 5% since bottoming out in June 2023.
Okay, lots for Wellington and the Wellington region. Show us that.
Okay, Wellington is interesting because there's lots of little cities here. So the hardest hit has been Lower Hutt. Property prices are still 26% below their peak. Now, they peaked back in 2021, October there, bottomed out in April last year. They've bounced back 5%, but if you own a property in Lower Hutt, you're probably not feeling too good if you bought at the peak of the market. Wellington City's down 20%, Porirua and Upper Hutt not too far off that as well. So Wellington has certainly been hard hit, but look how Upper Hutt City has actually bounced back 8% since the bottom of the market.
Queenstown?
Okay, Queenstown's a really interesting one. Property prices didn't really fall. It's so fascinating. They're only down 2%. We're saying that they peaked in December last year, so they basically didn't fall at all. And that's why we're saying only 2% down, because they didn't fall much at all.
Okay, Golden Triangle. I want to see Auckland, Hamilton and Tauranga.
Okay, we're going to start with Auckland. Property prices down 20% since the peak. They've bounced back 4%. Bottomed out in May, basically like the rest of New Zealand. One thing you've just got to think about with Auckland though, is Auckland properties make up like 33%, 35% of the entire country. And so what happens to the country often happens to Auckland, right? Because Auckland just sways the national data so much. In Hamilton, you're not doing so poorly. Property prices still about 13% below the peak of the market. They've bounced back 5%. And if we zoom in on Tauranga, about the same, bounced back 4%, down 14% in total. Now, I won't sit here tonight and just go through absolutely every single little part of the country. I'm pretty sure I've got that on the website somewhere, but I think it's always important to just acknowledge when we're talking about different parts of the country that not everywhere goes up and down at the same rate. But there is some interesting data out, Andrew, if we're thinking about, okay, property prices have gone down. They've started to go back up a little bit, but what's going to happen throughout 2024? Talk to us about some of the bank's house price predictions.
So with the disclaimer that nobody actually knows and everyone will get it wrong, probably, when you look at the predictions that are coming out, they are anywhere from 7.3% right the way down to 2% with Treasury. Now, these are being updated all the time, and some of the more interesting ones, or the more recent ones that are more interesting to me, are BNZ and Westpac. So they've got theirs come out in March, and you've got 4.8 to 5.9. Now, again, the truth might be somewhere in the middle. What's the average of those, Ed?
The average is about 4.3%. The median's 4%. So that just gives you a sense of, look, by the end of the year, 2024, by the time we get to December, how much might have house prices increased since last year? The answer is, could be around 4%, could be a bit higher, could be a bit lower.
Now, one of the interesting things is these forecasts, as time goes on, they tend to be trending down, right?
Yeah, so if I showed you these same numbers about 3 or 4 months ago, Westpac thought that house prices would be up. I think we got up to about 8%. For this year. BNZ was a bit higher. So they used to think that house prices would go up quite a bit in 2024. Now they're revising them down a bit. Same with ANZ. They were up at around 5.2% at one stage. Now they've brought it back to 3%. Treasury's gone the other way, but they're a bit conservative. So it's interesting that they are bringing it down a bit, saying, look, we don't think we're going to see as much house price growth in 2024 as we did a couple of months ago. But it's interesting what they think is going to happen the year after in 2025.
Well, before you go to that, if we're hitting the recovery, why is it a little bit slower than they thought?
Well, I think the main thing is interest rates are still really high at the moment. So they haven't come off quite as much as some people would have thought. And the other thing which we're going to get into is just the number of listings on the market. There is a lot of stock on the market at the moment. That's meaning there's a lot of choice. And so this recovery is not necessarily going to be one way where we say, hey, it's just going to get better and better and better. It's going to be a little bit up and down because there are some moving parts in the economy at the moment. So do you want to see my spreadsheet, Andrew?
Yeah, show me your spreadsheet.
So one thing, I updated all of those house price predictions only about a couple of hours ago. And one thing that was really interesting, I'll hide that for you and I'll make this bigger because this is really fascinating, is a lot of the banks expect 2025 to be a really good year for property prices.
13.9%.
Yeah, so ASB is currently saying, hey, look, we think that house prices are going to go up 14% in 2025. BNZ saying 10%. But the main thing, focus on this column here. Look at the change. Yeah, Kiwi Bank and Treasury think that next year, 2025, property prices might go up a little bit slower. But ASB, BNZ, Westpac, ANZ, they're all saying property price growth is going to start to pick up once we hit 2025. Really important to note as well that BNZ and Westpac, those are the ones that have the most up-to-date forecasts. Those have been released this month. Kiwi Banks and Treasuries, those are from 2 or 3 months ago.
Do you have the average of those?
I do. The median for 2025 is 5%. The average is 6.3%.
Okay.
So that just gives you a sense of where might property prices go. It looks like we're going to have 4-ish% this year, maybe a little bit higher, maybe a little bit lower. As we get into next year, it might be closer to that 5 to 6%. I mean, if BNZ and Westpac are right, it could be much higher than that.
I think it's important to remember, though, again, that not all areas will go up at the same rate. So you might get a 10 out of Auckland, but you might get a 2 out of somewhere else. So it will average out to maybe be these forecasts, or it might be completely wrong.
And that's a really good point to start talking about some of that listings data that we mentioned before. So this is the number of properties, if you were to go on realestate.co.nz, how many are available right now? And what are you seeing in this, Andrew?
So at the moment, you're kind of seeing a lot more stock entering the market. And one thing that's going to be really interesting to me this year is how the change in the bright line test affects the amount of properties that go onto the market. Because if you're an existing property investor who's hurt by the interest deductibility rules at the moment, you might be thinking, God, I just need to get out of this rental property, but I don't want to pay Brightline. So you might be holding on for that change in July and then put your property on the market. But then the flip side, maybe with the change in deductibility rules, which we're going to talk about later on, maybe now you can stomach holding on. So we'll see what happens over the future.
And some of our team here at Opus Partners, especially in Auckland, have been selling their properties recently. Talk to us about their experience.
Talk
to us about Kathy.
Oh, yeah. So Kathy, one of our property partners, they were going to sell their owner-occupied property, and they went to market, in the middle of summer. Really nice house, well priced, and they didn't actually sell that property at auction, which was surprising to me because only a few months earlier, Candice, who works for our Auckland team, sold their property, got above asking, had multiple people bidding at the auction. So it just shows me that maybe entering this year, there's a bit more cautiousness than maybe we predicted late last year.
Yeah, we had a bit of a bounce. It's just starting to go a little bit sideways. And I saw a really interesting article out of Kiwi Bank that was saying house prices are ready to go up once interest rates start coming down. And that's one of the things out from Jared Kerr at Kiwi Bank. One other thing that's been really interesting as well is that sales are taking a little bit of time to start bouncing back, aren't they?
Yeah, so what we're seeing at the moment is from the peak of the market where you had 100,000 sales happening every year, we're down to 60,000 a year. So quite a big drop. And at the moment we've come back to 64. So yes, a bit of an increase from 59,000, but still a big or a significant discount from the amount of sales that we had back in June 2021.
Cool, so let's start putting together our property market update. And we're going to do something a bit different. We're going to use a traffic light system. So if I think about where house prices are today, Andrew, whether they're increasing, whether they are decreasing, what colour traffic light are we going to give it?
For the future?
No, for today. What's happening today?
Orange.
You're going to say yellow.
Yeah, I was going to say that.
Well, the funny thing is, apparently, a lot of men have colour blindness. No, that's true. That's true. That's a good piece of health research for you today.
I was too busy reading a question.
We're going to call it an orange light at the moment. They're not falling. They are going up a little bit, but I don't think we're out of the gate yet. I don't think we can confidently say house prices are back to normal and they're going to go up by 5% a year. They will over the long term, but I'm just thinking we're going to see a little bit more up and down over the next year. It's going to be a little bit of a slower recovery over the next 8 months.
What about next year?
Well, if I think about house prices a year in the future, once we get into 2025, I think that's where things become clearer. And if I was to look into my crystal ball, I think we're going to move from that orange light to that green light. But some things need to happen before that we start to move into that green light. Now, I also want to do one about sales, the number of properties being sold, but I need your guys' help. So if you haven't been to one of these before, what we like to do is we like to poll you and see what you guys think. So my question for you is, what colour are we giving to the number of property sales a year, which is called sales volumes? Is it green, are lots of properties selling? Is it orange, it's going okay? Or is it red, it's not going good? And the cool thing is, it might be different for each person because some of you guys, in your local property markets, I'm just trying to find the bloody poll, Andrew, in your property markets, it might be going off. But in other parts of the country, maybe things are quite muted still. So I'm going to launch that across your screens. I want to know what you guys think. Has it come up for you? Yes, it has, Andrew. Because then we can get a sense of where everybody's heads are at.
Now, that's this year, right?
This year, right now. And then we're going to tell you what number we're giving it to you guys as well.
I still enjoy that people sometimes type these things.
Yeah. Don't see much movement in Wellington. That's really interesting, Ryan. Christine saying orange as well. I've had almost 400 people answer that now, and I'm going to close the poll in 3, 2, 1. End poll there, and I'm going to share that across your screen. So a small percentage of you, 6%, are saying green, going strong, and could be in your area. Most of you, 2/3 are saying orange, it's going okay. About a quarter of you are saying it's still red. That's really interesting. Now let's pull it up, Andrew, and see what we are saying. Let me get it into the right mode. Ooh.
Drum roll.
Here we go. So for sales today, I'm actually calling it red. And the reason I'm calling it red in terms of sales volumes is that we are still at an incredibly low level of sales, about 64,000. Compared to what we've been, it is the lowest number of sales per capita that we've ever seen since the data started. So I'm calling it red. Now, it doesn't mean that you can't sell your house. I saw a comment from someone in the chat
Peter, see they're selling next week.
I'm about to sell my house. I need to make sure that it's going to be okay. Tell me it's green. You'll probably still sell your house. I'm just saying, in terms of the number of property sales, the average in New Zealand has been about 78,000 per year. We're currently sitting at 64,000. Now, if I project a year into the future, I'm not calling it a green light. I don't think we're going to be at 78,000.
You're so conservative. You're such a nerd.
I'm a nerd because I've got my glasses and I'm here talking about data. But I reckon we'll still be at orange in a year in the future. Again, doesn't mean you can't sell your house. You'll probably still find a buyer. Over 60,000 properties are still selling a year. But I'm just saying, I don't think we're going to be back at that average of 78,000. Right. We've done what we need to do with the Real Estate Institute of New Zealand. Andrew, let's get on the plane.
Where are we going next?
We're flying to Wellington. Here we go. And we're better to start at our property market update. We're heading to the Beehive. So come on.
Have you ever been to the Beehive?
I have. Empty your pockets. We're going through the security system. So talk to us
this
about...
is me.
I know.
So there are two major tax changes which are about to come in. The first is the bright line test is going to be revised, and it's going to be 2 years as of the 1st of July. So what that means is if you were one of those investors that purchased within the 10-year bright line and thought, holy hell, I've got to hold this property for 10 years or I'm going to pay income tax on the profits when I sell it, that's no longer the case.
And one thing I want to mention is I think a lot of people missed this because Nicola Willis, the finance minister, she came out and made the decision, made the announcement back on the 20th of December, back last year. But I think because we were all off, ready to go to Kiri and ready to go off on our holidays,
Fiji,
we kind of missed it. We might have missed that one. But the bright line test is going back. So I should have been looking at my wine in Kiri.
And so if you think about buying a property on the 31st of June, previously you would have been captured by the 10-year bright line test, which is a long time, particularly because the average property in New Zealand is held for about 7 years, right? As of the 1st of July, 2-year bright line, which was the original bright line test brought in by National, that applies now moving forward, and it's applied retrospectively as well. And that's one of the most important things. And I do think this has the potential to change the property market a little bit. There'll be things pulling one way and also pushing the other way. But if you think about the number of people that are hurting right now because high interest rates, interest deductibility, and yes, we're going to talk about the interest deductibility next, there will be people here that say, you know what, I'm done with property investment, and they're going to sell properties. There might be a push of listings.
Fantastic. I like that people say only 30 days of June. Do you know what's funny? I was actually trying to think of that when I was putting together these
30
slides.
30 days has September, April, June, and November.
I thought it was April, May, and November. I messed it up.
Call yourself an economist.
I couldn't be bothered
reciting that.
I couldn't be bothered checking my calendar, so I thought it was 30 days has September, April, May, and November. So you've corrected me. It's June. Okay. That's good.
Second of all, you learn something new at these events every month. Interest deductibility. So it is mostly going to be gone in 19 days. Can I get an amen? This is one of the biggest things that's been affecting anyone that invests in property, in older properties and properties that they've renovated or they've got a portfolio. This has really hurt investors over the last wee while. And from a cash flow perspective, people don't, thank you, Grant, people don't really understand the impact unless they're paying that tax bill. So let's actually look at what a difference that makes. Say you bought a property for $500K and you're looking at buying it today. Now, rents for $540 a week, let's say. If you look at the forecast based on what we predict with interest rates, your contribution with the cash flow contribution in terms of the amount you need to put in to cover all the costs, plus the tax you need to pay, is horrendous over
Yeah.
the next 15 years.
Almost 300K. Now that graph on your left, that is the annual property cash flow. So while interest rates are high, plus all of the tax you'd have to pay, you'd have to put in $800 to cover all of the costs for that specific property.
So let's look at what this looks like under the new tax policy. So yes, you've still got those negative years because interest rates are still pretty high, negative 51, but you've got the advantage of this side, positive $60,000.
Now, what's amazing here is it's the same property, the same mortgage, the same level of rent, the same tenants there, the same increases, the same interest rates, the same rental increases, I should say. The only thing that has changed is the tax bill. And how much of a difference does that make, Andrew?
$118,000. Ed told me when he put together these numbers would shock me. Absolutely, $118,000. And moving forward, again, this particular property, no tax to pay because you are making a loss in those first few years and you can carry that loss forward into those profitable years.
That's correct, Andrew. And so we are going to see a massive shift. In fact, I had a call.
Oh, this one's me.
No, it's not. So I had a call the other day from Stuff. From Miriam Bell, who's a journalist there, really like her, and she said, Ed, how much of a difference does this make to investors? Huge difference is the answer. Just a massive difference to property investors. So I think we'll see some people enter the market. So if we're thinking about tax, now we're sitting here, it is the 12th of March. Today, the taxes are really bad. I would call them a red light. And the reason is we've got interest deductibility right now, the day we're recording this. It's about to get better, so I'll show you what I think it's going to. And we've still got a 10-year bright line test. That doesn't roll back until the 1st of July. Now, Andrew, tell me what it's going to be a year in the future.
I think green.
It's got to be a green.
Yes.
It's got to be a green. We're going back to the good old days with some saner tax rules. We've got a podcast coming out about interest deductibility on Thursday. Producer David is nodding. So we'll have some more detail around that for you guys on Thursday if you want to dig in more. Right. We've had our dash, done our dash at the Beehive. Let's head to the Reserve Bank. I'm coming for you, Adrian. So if we think about inflation, inflation is coming down. We're currently sitting at, I think it's 4.7%, down from when it peaked at 7.3% back in 2022. And the Reserve Bank actually thinks that inflation will be back within its target band by September.
So does that mean we'll get low interest rates?
It doesn't mean the OCR is going to come down anytime soon. But I think this is really good news. We have seen inflation absolutely plummet over the last couple of years. Now, there will be some people down in the comments section, saying, well, a lot of the decrease has been in tradable inflation. So imported inflation has really fallen, whereas domestic inflation here in New Zealand, non-tradable inflation, that's been a little bit more sticky. That is absolutely true. I've got a couple of things to say about that on my YouTube channel if you want to dig into it a little bit more. But what I will say is the Reserve Bank, their current forecast, which came out only 2 weeks ago, they think inflation is going to be back in its box by September.
So didn't Adrian Orr make a comment at the last release talking about that?
Well, what he said, and I really liked what he discussed, he said that you could look at a range of data, and if you cherry pick all of the good data, things only look good. And if you cherry pick the bad data, things only look bad. But you've got to look at it on balance. And what they were saying is that on balance, the economy is developing how they thought it would. But even though inflation will be back in its box or close to it, they don't think that the OCR is going to come down anytime soon. At least that's what they are currently forecasting. So they think that the big falls will come in 2025 and 2026. Doesn't mean that your mortgage interest rate is going to stay high that long, but that's what they are currently saying they'll do with the OCR.
And actually, we've got a podcast coming out on how the OCR affects fixed interest rates in the next week. And it's quite interesting to note that it doesn't have a direct correlation. So I think that the maximum correlation it has is 80% of the change within 6 months of the change happening. So what that means is if they make a 1% decrease or increase, it takes 6 months for 80% of that to flow through.
That's true. The other thing that I do want to mention is I recently released a column for One Roof. So I write a column in One Roof every single week. And I talked about interest rate cuts and specifically what the Reserve Bank said at the latest monetary policy statement and whether you should believe it. And there was one thing that I really do want to show you, one specific graph. I mean, to be honest, there's lots of specific graphs I want to show you
why I laughed.
in today's presentation. But I specifically want to show you this one on the One Roof website. You can go and check it out. I hate that photo.
Look at that photo.
I don't know why they chose that, but the sun was right in the eyes.
Pretty.
Would you date me?
No.
Sorry, that's terrible. So this is how accurate the Reserve Bank's OCR predictions are. And so I looked at all of their forecasts over the last, I think, 30 different monetary policy statements and looked at, well, what did they say they would do versus what they actually did? And what I found was that within the first 7 months, the Reserve Bank pretty much does what it says it's got to do. But over time, they start to deviate. So a year after they make the forecast, on average, they're about 0.8% away from it. What that means is if they say that the OCR is going to be 5.5%, it could be as low as 4.7%, or it could be another 0.8% higher. So my point is that the Reserve Bank usually keeps talking tough until they make a change. They want to keep the brakes on the economy so that inflation comes down until they're like, hey, we need to bring it down, otherwise we're going to cause a big recession. So I think it's really important to just say, cool, that's what the Reserve Bank said they're going to do. Let's see whether they actually do it in practice. So you can read that on oneroof.co.nz if you want to dig into this a little bit more. But there's one other major change, Andrew, that the Reserve Bank is planning. And so while we're sitting here at the Reserve Bank talking to Adrian Orr, what else has he announced recently?
So the big change will be the debt to income ratio rules, which are going to come in. And that was last month's webinar. So if you really want to dig into the detail and you don't know about these, go and watch the last webinar, which is available on our website. But basically, if you're an owner-occupier and you want to borrow money, you need to borrow no more than 6 times your income, and that includes all your debt, 7 times your income if you're an investor, but that includes your rental income as well. Now you get a bee in your bonnet about this, don't you?
I do, but what I do need to say as well is Adrian Orr's come out. He hasn't got his big stick, but he's got his big chalk, and he's come out and he's written a new rule. So no more for investors, no more than 20% of each bank's lending can be above 7 times DTI for investors. Now, hold on to that 20% figure. I need you to remember that because we're going to come back to 20% of each bank's lending in a second. But I do get a bee in my bonnet, Andrew, because I am seeing some people using the DTIs to create fake scarcity. I think it is unethical.
You're like Donald Trump now. Fake news.
No, this is fake scarcity, and I've got some facts to back this up. So I was coming down to Christchurch yesterday. I told you about this. Forgot my shirts, and I saw a post on Instagram.
There's a window of opportunity to buy and invest in residential.
Speak louder, they can't hear you.
I'm reading to myself. This is what old people do. So basically, this person is suggesting that you need to buy a residential property before June 2024. Then otherwise the DTIs will restrict the ability to borrow. So that's fair enough.
Now, this person runs a property investment company. They're trying to sell new builds. Now, just to be very clear, these are one of our competitors, right? Because we sell new builds here at Opus Partners as well. We help people buy them. But the reason I find this unethical is this person sells new build investment properties. Now, why would I call that unethical? Because they're saying you need to buy an investment property, probably off me, is what they're saying, before June, otherwise you might not be able to do it.
So it's creating this panic.
But why is that not true?
Because new builds are exempt from these DTI rules.
Yeah, so I kind of think of it as saying, come and buy my ice cream before it melts, but the ice cream's in the freezer. So they're saying, you need to buy now, otherwise the rules will impact you.
David's asked who?
David, we'll see. But I've got another example, because they're not the only one. Nikki Connors isn't the only one. I saw another post on Instagram, RBNZ set to reduce borrowing capacity. And then I see this one here, don't wait, act now and explore your mortgage options while you still have flexibility. This is from a developer.
Who sells new builds.
So that it's this fake scarcity that I really don't like. And so I think it's really important that we just point that out and you guys are aware of it because the Reserve Bank has confirmed that new builds are exempt. So they're saying you need to buy now, otherwise you can't in the future, but that's a lie because you can in the future because the new rules don't impact new builds. Really important. The other reason why I call it fake scarcity is if we think about how many people the DTIs will really impact, this is investors, this is owner-occupiers borrowing at high DTIs. Now that darker purple you can see, that's the 20% limit that I just talked about, how banks can lend up to 20%. We are well under that. DTIs, if introduced right now, would have almost no impact on the market today. So this idea of, hey, you need to buy right now, otherwise the DTIs are going to stop you, I actually think that is an unethical lie. So I just want to point that out, because the DTIs are really about future-proofing the market for when interest rates drop. Right, before we leave the Reserve Bank, Andrew, let's talk about inflation. What is it today? Is it a red light? Is it a green light? Is it an orange light?
I go with orange.
I'm calling it red.
Oh, yes. Like,
why are you laughing? Why are you
just
angry?
because I know what you do. You know what I'm going to choose based on the way I think. And then you set it as something different just so you can argue with me.
It's just because I know you. You're going to be like, things are all good. I call inflation a red because it's still 4.7%. Yeah, it's coming down. It's better than 7.3, but it's outside the target band. What do you think in a year's time?
I'm going to go with green.
I'm going to go green too. Now, that doesn't mean that the OCR is going to come back down really, really quickly in a year's time. All that means is inflation is back within its target band and things are likely to get a wee bit easier. What about DTIs? What are you calling it today as a traffic light?
Non-existent. So green?
Green, that's correct.
Yeah.
Well, that's what I'm calling it too. DTIs
got you there.
But what do you think in a year's time?
Orange.
Why is it orange?
Because some people it's going to affect, some people it's not going to affect.
I think the other main reason I'm calling it orange is that once they're introduced, DTIs, as I just showed you, they will be what we call non-binding. So they will be in place, but they actually won't restrict the market because there's not that much high DTI lending going on. And the other thing that I find is a wee bit unethical is that some of these companies that I see on social media are saying, you're not going to be able to borrow more than 6 times your income or 7 times your income. And that sounds really scary, but there aren't that many people borrowing above 6 times their income as owner-occupiers or first-home buyers right now. There aren't that many people borrowing above 7 times their income as investors right now. So it sounds scary, but actually it's not when you put it into context. And I just think it's a bit of a haphazard, you need to buy from me right now kind of thing, and I just think it's grubby.
Yeah, didn't you release a tool that people can use to see how it would impact them now?
Oh yes, I did. I released
Show us
I released a calculator. I need to dig through. I don't want to dig through because I don't want to get us off track more.
Can I put it for Q&A or no?
You can put it in Q&A. Write that down, Andy. Rightio. Oh, whoops! I forgot. We've got to talk about this part.
Your boyfriend, your parents-in-law are going to realise
yet.
Oh, sorry.
So one thing I want to mention, or just want to bring up, is while we're in Wellington, we can't leave Wellington, Andrew, until we talk to Papa T, Tony Alexander, one of our favourite economists. And yes, I will have some milk powder in my tea. Thank you, Tony.
Milk powder?
I'll tell you a wee story very quickly. When we first met Tony and had him on the podcast, he was telling us, this was before COVID, and he was telling us about how I think it was
No, it was just after COVID. So what happened?
Before COVID. No,
Okay.
I know, because I remember these things.
Right.
And he was telling us, I think it was about the Ebola virus, and how he'd bought all of this milk powder, right? He'd bought all of this milk powder in case we had to lock down. And then he had to flush it down the drain in the end. I think it was 100 kilos of milk powder.
So hang on, let me ask you this, Ed McKnight. Why would he flush it down before COVID?
Because it was going off because he bought it for a previous pandemic.
Nah, you're wrong.
No, I'm not. I'm not wrong. I know exactly what I'm doing, and I know I'm correct here. Right, let's get back to the property market data. So are we noticing fewer or more investors in the market? You could see that this goes from 2022 through 2020 right through to 2024. And what you can see is just before COVID, we had a lot of investors. Then the last couple of years, we haven't seen as many investors in the market. They've just been starting to come back over the last few months, and they've just started to pull back. So this is something that we're going to keep a little eye on over the next couple of months. Don't have much more to say about that because we've got a flight to catch, Andrew. We are now going to sunny Nelson. We're here to talk to Pete, who is one of the listeners of the show. I'm sure Pete's probably on the webinar tonight. He's promised us a coffee here. And so we are going to go along to the local ANZ. Andrew, do you want to talk about this?
Well, I wasn't that big a fan of an ANZ a couple of weeks ago because they talked about the OCR going up 2 more times before they came down, and that got everyone in a bit of a flurry, right?
Yeah, and while we're here at ANZ, what I want to do is I want to talk about the 1-year mortgage interest rate. And you know what? I'm going to come back. I'm going to ask the audience, what do you guys think the 1-year mortgage interest rate will be in 12 months' time? Will it be above 7%, 6.5%-ish, 6%, or 5.5% or lower? I'm going to stop sharing my screen and I'm going to put that poll across yours so that you can tell us where you think the 1-year interest rate is going. That's across your screens now. And once a couple of hundred of you have answered that, we'll dig in and see what you all think. One of the, I'm very glad. I've just seen, I don't know why she texts you.
Yeah, because I'm the favourite.
So my partner texted Andrew saying he liked the shout out. Maybe she missed the earlier one that we did. And I didn't get the text, he got it instead.
Yeah, that's right.
So it's interesting to see what you guys are saying right now. We've had almost 450 given the special rate we're talking about, not standard. If it was standard, it'd still be very high.
What I find interesting here is we get all this data every month, and it'd be really interesting to look back and see the answers and whether or not the wisdom of crowds gets the right answer.
Cool. We're going to end that poll in 3, 2,
interested.
1. Oh, Andrew.
See what I put up with, Angela?
Cool. So only a small number of you guys think that the 1-year interest rate will be 7% or above by the time we get through to March next year. A good number of you think it's going to be around the 6%, maybe 6.5%. Only a small number of you think that it will be 5.5% or thereabouts. Really interesting to see what you guys think, because I now want to tell you what ANZ's current forecasts are. They probably give the best or most descriptive stats that we get, i.e. they actually release a good forecast. So they're actually saying that they think the 1-year fixed rate will be as low as 5.7% by March next year, 2025. So you guys who said 6%, you guys who said 5.5%, you're along the same lines, thinking along the same lines as ANZ. I'm not telling you you're right because it hasn't happened yet. Who knows? Maybe you guys who are saying 7% plus, maybe you guys are right. We'll have to wait a year to find out, and you'll have to come back to the next webinar to see. But that is currently what our largest bank in New Zealand, who makes up about 40% of the mortgages given out in New Zealand, currently thinks, about 5.7%. So if we think about interest rates today, it's a quick stop in Nelson. I'm calling it a red light. Are you okay with that?
Yeah,
Andrew?
fine with that.
It's
painful.
Really painful at the moment, not very good at all. I'm calling interest rates in a year's time. While I think that people will feel pretty good about it, while I think a lot of you are right that it will likely come down a bit, I'm still calling it an orange light, because even if ANZ is right and interest rates come down 1.3% or higher, it's still going to be a high interest rate.
I think
you disagree with me.
We're going to all feel pretty good if their projections are right, because we're facing really painful interest rates right now. But Ed's right, it's still above what we would expect the long-term average to be. So I get the orange.
So orange or green, up to you guys to decide. It really depends on your outlook. Okay, we've got one more flight to catch, Andrew.
Where are we going?
We're coming to Christchurch. Yes, come on. We're boarding NZ 5827. We're landing in Christchurch. We're getting out Uber.
Did you look up these flight numbers?
No, I just made that up. And we are heading to the Opus Partners office. We're heading to the studio. Here we are right now, Andrew. And we want to talk about what's happening with supply side. So what's happening with developers right now?
So this is the most interesting thing to me, because at the moment you've seen a massive drop off from when the peak of the consents were being issued. So developers buy some land, they plan to put 100 units on that particular site, they apply for consent. That has dropped drastically over the last couple of years. And now we're in a position where there are fewer consents being issued. And remember, not every building that gets consented is going to actually be built, because now we've got higher interest rates. It's harder to get lending. There might not be the sales to warrant actually doing that development. So let's say 50% of them get built. We're down 36%, and of those 64%, you're not going to have all of them built.
That's correct. The other thing you've got to remember is a new dwelling consent can be mum and dad, they've lived in a property for 30 years, they're pulling it down and they're replacing it with a new property there. So that doesn't necessarily add supply to the market, but we are seeing consents very, very far down. And of course, here at Opus Partners, we specialise in new build properties, right? That's what we help people invest in. And I've been digging a little bit deeper to see, well, which developers are doing it tougher. So I know you guys really, you love this data, so you're ready for it. We are seeing some developers doing it a bit tough. So you can see Mike Greer has gone from about 700 and something consents per year all the way down to just over 400.
That's from the peak.
That's from the peak. Wolfbrook have gone from about 300-ish per year down to just under 200. And Williams Corp has gone from high 700s, around that 770 mark, as reported by BCI, down to under 200 in the year 2023. So over 2 years, quite a massive decrease there.
Now, just as someone that works with the developers all the time, this doesn't mean that someone's in trouble necessarily. This just means that they're not consenting property. So they might not be buying land, they might be seeing out their existing projects, but it's interesting to see the pipeline dropping off.
And one thing I think this does is it creates the opportunity for negotiation.
How many people are old enough to remember Ben Rumble?
I don't know who Ben Rumble is.
Really? Top deals, top service.
Yeah, I'm sure that's what you think. But the reason I put Andrew here is it does create that ability to go out and negotiate. And I'm going to get him to talk about a deal he's recently negotiated down in Christchurch. But if I think about the number of consents out there, and specifically, this is really if you're looking to buy a new build property, which not everybody is, and it's not the right fit for everyone. Today, I'm calling it a green light for negotiation, because there are a lot of developers out there struggling at the moment, and that just means that you guys, if you do want to invest in a new build, there is that opportunity to negotiate hard and get a good deal. We'll give you an example of that in a second. In a year's time, it's not going to be a red, but I think the market will come back a bit. That's going to mean that developers are in a bit of a stronger position as buyers start to come back. I saw some of you guys saying it's definitely a buyer's market at the moment, and I agree with you. In a year's time, I think it's probably going to change. So I'm going to call that an orange light. But Andrew, in terms of negotiating with developers, I just want you to talk through a deal you recently negotiated, just so that you can, people can get a sense of what's actually possible.
And I don't want anyone here to think, hey, that's a great investment, I should go and buy that. This is not to sell you an investment property and say, this is what you should be buying. Again, like Ed said at the start, this is for general information, not personalised financial advice. But a great development for people looking for growth is 888 Colombo Street. So just to give everyone some context as to where it is.
It's in Christchurch, because we're in Christchurch at the moment. We've taken our flight down here.
But we're within the 4 Ave. So whenever we talk about Christchurch CBD, we talk about being within the 4 Avs, Beeley, Fitzgerald, Morehouse and Deans Ave. So you're right smack bang in that. The lower of the 2 points of reference, that's our office. And then if you go up to the top, oh no, it's not, it's good.
It's the cathedral. It's Cathedral Square.
Very close to our office. And if you go up the top, that's where the development is. These have got valuations of $730,000, which I still think is very good buying for right in the CBD. We've negotiated them down for under $700,000, $699, so a $31,000 discount on the valuation.
Now, I just need to be really clear. If you are one of our clients buying one of these, not all of them were valued at $730. Some of them were $720. So some have a $21,000 discount, some have a $31,000 discount. But that just gives you a sense of the discounts and the negotiation that is available at the moment. I really need to tell you as well, that valuation is not just what some real estate agent said. That is a registered valuation where somebody who's qualified to go and value properties has come out and said that's what they're worth.
And I think the interesting thing about this valuation is this is the valuation that someone's put on it based on comparable sales right now. This project isn't finished for 18 months, so I think there's some benefit in the fact that, okay, well, this is something right in the CBD that I don't have to pay for until 18 months rolls around and it's finished, but I'm getting a discount on today's value.
Okay, so that gives you a sense about that. But let's add up all of the things we've discussed so far. To answer that question, what's the state of the property market right now? So if we look at house prices, I'm calling it an orange. I think over the next year, it's going to move to a green. If we think about sales, tax, inflation, I'm calling them all red lights right now. The market's pretty tough at the moment. Sales aren't that high. I think it'll move to an orange. Tax and inflation I'm calling it a red light right now. In a year's time, in fact, for some of the taxes in 3 months' time, got to move to a green light. DTIs is a little bit different. It's going the other way. Same with negotiation. We're currently at green lights. We're moving to orange. Same with interest rates. But when you add it all up and look at all of these factors, and I haven't even included rents here, right? We haven't had time to look at what's happening with rents. I think that we're moving from a pretty tough market, and by the time we get a year into the future, things will start to look pretty good. And I think that provides a couple of opportunities for people if you are thinking about making a move over the next couple of months. And Andrew, I know you specifically wanted to talk about one specific opportunity you're thinking about as you're looking at these and weighing up the property market.
Now, again, we deal in off the plan or new build investments. Some of them are ready to go now. Some of them are ready to go in 12, 18 months like Colombo Street. I want to tell you why I like stuff that's not finished today. So if you're buying something that's off the plans and you're buying it today, you're confirming on it today and you're putting a deposit down, and right now prices are low but interest rates are really high. If you don't have to settle it for 12, 18 months time, what do we think will happen with house prices? Well, probably they're going to go up. And interest rates are probably going to go down. Now, there's no guarantee of that. It might not happen exactly like that. But that's probably what the wisdom of crowds and wisdom of banks would believe. And so all of a sudden, you're settling a property when the house value is higher and the interest rate is lower than what you've done your numbers on today.
Couple of things to keep in mind though, of course, is there are no guarantees. Interest rates could stay high, property prices could stay where they are at the moment. Really important to talk about those kinds of risks. And that's why if you do decide to invest in any market, whether property prices are rising or whether they're falling, you do have to accept some risk. It's not a one-way bet, right? So look, I do want to get into question time, but usually at this point of the webinar, there are a lot of people, especially those of you who are new here tonight, and there's a couple of hundred of you, you'll often ask, well, what do you guys actually do? And even after recording 1,650 episodes of the Property Academy podcast, doing 50 webinars, subscribing to their magazine and reading our books, some of you will still ask, what do you guys do? So I just want to take 2 minutes to talk about that, just so you have know what options are available to you. Can you stop scribbling so loudly and ripping off this paper? Otherwise, nobody's going to be able to hear what I've got to say.
Sorry, there were some good questions.
Here at Opus, we do 2 things for you. So the first is we can create a property investment plan, and that's a real meeting of Andrew sitting there with an investor. He's sitting on the floor of his hotel because there wasn't a desk in that specific room, talking to some investors. I think they were in Singapore actually, about their
Australia.
plans. Australia. And then the other thing we do is find new builds for you. So Andrew's given you an example of some of the new builds he's negotiating at the moment. So if you are looking for someone to help you with that, create that plan, find new builds for you, then we might be the right fit. And that's one of our financial advisors, Kathy Faulkner, sitting there looking at properties. Again, a real meeting with an investor. Important to say, you don't have to use Opus Partners, right? So if you Google property investment companies NZ, there will be other people who come up. Yes, we're going to be on there because we do a lot of content, but there's Propeller as well. We talked about them earlier on tonight. There's Property Factory, there's Positive Real Estate. Like, you have options. You do not have to use us. But if you're thinking, well, why would I use these guys as opposed to somebody else? I think there are 4 big things that set us apart of why you might say, okay, I'll use them over someone else. The first thing is we use the most data to make good decisions. Most of it is available for free on our website. You can just go and find it. And some of you use that data all of the time, and thank you so much. The second thing is we find properties that you can't find on TradeMe. So those properties Andrew just showed you with the discount on valuation, they are not on TradeMe. You can't find them. Those are for our clients. So first of all, you become a client, no cost for that. And then we have some properties that you can't find on TradeMe. The other thing we're quite big on is negotiating good prices and getting good deals. So every single property we now recommend comes with this in the property pack. And I know that this is a little bit blurry, but this is from a real property that we recommended to some investors with some comparable properties that we were saying these are other ones on the market. So we're trying to prove to you guys that we have gone out and found a good deal, because we need to make sure that you guys understand, like, cool, that it's been negotiated, they've gone out and found it. And the last thing is all of the support you need in one place. So yeah, you can buy a new build through our service. You can also get it managed through Opus Property Management. You can get the mortgage through Opus Mortgages, and then also get the accounts done and the taxes paid through Opus Accounting. And if you want to take this further, we have a free meeting. There's no cost for our service. We get paid when you decide to buy a property from us, and we get paid by the developer. And there's no fee for investors. So if you're thinking, look, I enjoyed the webinar tonight, I kind of like what they're talking about, I'm thinking of buying a new build, so yeah, I'll have a chat with them and get a portfolio planning session. There's no cost for that. And if you are keen for that, I'm going to put one final poll across your screen. It just says, are you keen to book in one of these free sessions? If you click the top one, we will send you a link to book your time tonight or tomorrow. And if you click the bottom one, then you'll be good right now. You won't get a link, we won't call you, and no worries. Thanks for coming along, we really appreciate it. And just before you jump in, Andrew, I'm going to launch that final poll across people's screens, just so you have the opportunity to say, yep, I'm keen to talk to you guys, or you know what, nah, it's not for me. Now, what are you going to jump in about?
You said to book your session for tonight or tomorrow, you mean you'll get a link which will allow you to book. It'll be sometime tonight or tomorrow.
Sorry,
you don't have to see us tonight.
No. But we're going to be at Roka, if you want to see us. Roka in Christchurch. No, we'll send you a link so you can just choose a time that works for you and your partner to come along to. And I always think at this stage of the webinar, these webinars aren't to say everybody needs to come and see us, because not everybody will choose to come and see us. Not everybody needs to come and see us. In fact, I saw an investor come through just, I think tonight actually, who currently owns 10 properties. Actually, they're probably sorted for retirement. They're probably sorted for their financial plan. They probably don't need our help. But if you're kind of somewhere between 30 to late 50s, and you're thinking about retirement and thinking, hey, I need to invest for my retirement, we're a really good fit for you. If you already own 10 properties, we're probably not as much of a good fit for you, because you already know what you're doing and you're already sorted for your retirement.
Having said that, there's people that just want a bit of a sense check. So every now and then I'll meet with an investor who's got whole lot of properties, and they want to know what's performing and what's not, and we can go through and kind of figure that out and figure out what the next steps are. And it depends on what your goals are. We'll just as quickly tell someone not to buy anything more and just to stay the course, as we will to tell them to keep investing if that's what's right for them.
And last thing, before we get into that Q&A, if you want to learn more, listen to the Property Academy podcast. Episode 1643 came out today. What was it about, Andrew?
Brightline.
No, it wasn't. You made that up. It was actually about where properties are selling above and below CV. So episode 1644 comes out tomorrow.
I talked about Mike Hamill, my hairdresser.
Tomorrow is a case study. And then also 2 new videos out every week on Monday and Wednesday. Subscribe to our YouTube channel. We are thankfully now the most popular property investment YouTube in New Zealand. Or property YouTube in New Zealand, I should say. And also, if you're a reader, check out our book. It's called Wealth Plan. It's in bookstores, or you can get it at wealthplanbook.com. $39 with free shipping around New Zealand. And we are so pleased that we have now sold 5,000 copies. I remember back when our publisher was telling us not to print 1,500, just over 1,000. No, don't print over 1,000. You won't sell that many in New Zealand. You guys have really supported us. We're really grateful for that. And we've now sold 5,000 of those copies. So thank you to everybody who's picked up that book. And thank you as well to everybody who's read it. It really means a lot to me when you guys actually make your way through that book. Rightio, let's get to Q&A. What else would you guys like to know?
I'm going to start with Mike. Mike's asked the question, Andrew, do you have your spreadsheet updated with the new tax laws? Now, Mike, I'm assuming you mean the portfolio analysis. The answer is no. So Ed told me he'll only make the changes once the new law comes in, because he doesn't want to change it twice. Well, we've got the new announcement. This weekend, Ed will be changing that spreadsheet.
So the ROI calculator is already updated, so that's good. You can download that from our website. For the portfolio analysis, we'll see when I feel like doing it, to be honest, Andrew. I've got a lot of things on at the moment, and I'm a little bit short-staffed.
Ed, that's a good point. Ed, question, tell us about rents.
Oh yeah, I can talk to you a lot about rents at the moment. It kind of depends where you are in New Zealand. One thing that I've been looking at most recently, and I'll show you this, I always Google my own website. So,
and yourself.
Opus Partners, how much do rents go up? So if we're specifically looking, here we go, that's what I'm looking for. So if we're thinking about how fast rents go up in New Zealand, this data was updated in December, and you can see as a whole, the country's rents go up pretty consistently. We've had a small increase in December, but what I'm really interested in is this graph here. This is probably one of my favorite graphs. So this shows you in December, we've started to see rents really pick up again, up to about 5.8%. So this is, I like to use the average over the last 12 months of how fast rents are increasing. Because if I look at the actual number here, you can see it jumps around a lot. That's the light blue line. And so I average it out, but it can be a bit volatile. So across all of New Zealand, we're still increasing faster than the historic average. The historic average is about 4.7%, and we've seen it go up by 5.8%. At the moment in Auckland, it's going up faster than that. Over the last 12 months in Auckland, we've seen rents, or the median rent, go up about 8.3%. In other parts of the country, obviously it's been fast, but not quite that fast. Christchurch around about, I think, between 5 and 6%. If I just talk about some of my own properties, over the last couple of weeks, I've put the rent up on 2 of mine in Christchurch by $35 each a week. And the tenants are all happy with that. That was the recommendation from the property manager. That represents quite a large increase because mine were under rented a little bit, but that kind of shows you what's possible. Together, that will mean that my properties are better off by $70 a week in terms of cash flow. Some of that obviously goes to the property manager because you've got to pay a management fee, but it certainly helps at times when interest rates are really, really high.
Okay.
I want to answer Karen's question because it was a data question. Where are you getting the data from to create the 12-month rolling average of median rent growth? Kieran, sorry, not Karen. Kieran, that is coming from IMB. If you Google rental bond data, it'll be one of the first thing that comes up.
Someone asked the question, and it was in the chat, so I shouldn't answer it, but I'm going to anyway. Is it better to buy a townhouse or a house? And then I'm going to group that together with someone else asking, is there an oversupply of townhouses in Christchurch?
Oh, Kieran, that's really interesting, by the way. You're saying it's out of date. That specific data, if you go on tenancy services, yes, that stuff can be out of date. The data I've just shown you can be 2 to 3 months out of date, but it's a different data set. Sorry, come back to it.
So townhouses, is there an oversupply? And should I buy a townhouse or a house?
Are you asking me?
Yeah, well, you've got all the data for it.
There's a really good article, actually, that I've released
and I'll find something for me just here.
On our website, which is Oversupply of Townhouses. I think this was also published in Informed Investor that I want to get into. So this was last updated about mid last year was when I last updated my data there, which is, are there too many townhouses being built? And the one thing I wanted to look at was one thing that I wanted to say, first of all, is townhouses are becoming extremely popular. So up to kind of mid-2023 last year, we were seeing that, you know, instead of 5% of new dwelling consents being townhouses, it's gone up all the way to about 42%. It's increased quite substantially there. So we are seeing townhouses becoming quite popular. But one thing I wanted to get into was I started looking at different tests. So if there was an oversupply of townhouses, we would expect them to take longer to sell than houses, right? So if there's not an oversupply of houses, they'll sell normally. If there's an oversupply of townhouses, townhouses will take longer to sell. We don't see that. So this is the median days, 12-month rolling average, to see is it taking longer to sell a house, and I think this one was specifically in Auckland. We are actually seeing townhouses sell only about 2.8 days longer than a house. This data goes up and down. So we're not seeing that symptom of an oversupply. Okay, what else would we expect to see? We'd be seeing townhouses falling in value faster than other types of houses. Actually, we didn't see that. We saw the median price of townhouses go down less than the median price of a house. So what I was trying to say is, if there was an oversupply, what would you see? Are we seeing the symptoms of an oversupply? The answer is no, and I could go on and on and on. Read that article, it's a really good one, quite proud of that one.
Before you change, a follow-up question, why don't apartments appreciate at the same rate as houses or townhouses?
Why do apartments?
Why don't they?
I think the main reason is you can see supply on apartments go up much, much faster. I think the other thing is fewer people in New Zealand tend to live in apartments, so there's probably a smaller amount of demand. I think the other thing is that high body corporate fees probably scare people off as well, and it takes longer to do DD on it. I think it's probably just not in our DNA at the moment.
Correct. Someone said, should I buy now or should I wait? Now, we did a podcast the other day on this, or this was part of it. And I think the answer is it depends, which we hate giving the answer, it depends. But take someone right now who's double income, no kids, or the kids have left home and they've got good disposable income. They want to take advantage of the low prices in the market, but they can afford a high top-up because interest rates are high. They should buy now if it fits their goals. On the flip side, say you've got someone who maybe is on a reduced income because someone's not working because they've just had a kid come to the family and they don't have the disposable income. They want to take advantage of the low prices. Well, you could buy something if it was off plans that was completed later, so long as you could be sure that you're going to be double income again and it fit the criteria and you were able to afford the top-ups later on. If you can't afford the top-ups, do not buy now.
So Renee asks a really good question, which is, what is the definition of a townhouse compared to a house? Now, the answer is there isn't really one. But so when we're giving you this data, what actually happens is real estate agents, when they report a sale, they go to the Real Estate Institute, they fill out a form and they tick a box. Is the property a dwelling? Is it a townhouse? Is it a unit? Is it an apartment? And there are lots of other different sections as well. That's where the data comes from. So it's up to the real estate agent's judgment about what a townhouse is or what a townhouse isn't. Now, if you asked me, and probably most real estate agents in the country, they'd be thinking about what some people call terraced housing. So is it a unit on a smaller plot of land connected to other units as well, potentially with a car park, potentially with a garage? A house is a standalone property on its own section, but ultimately the data comes from whatever the real estate agent puts into the REINZ. So I do think that's just important to note. Something else. What else are you thinking of right now?
Another one was around population growth. Someone asked about the population growth for Christchurch. Have you got any data on that?
Population growth for Christchurch expected over the next 25 to 30 years is about 15% from memory. So a little bit lower than the country's average. The country's average is 25%. Christchurch about 15%. One of the reasons the country's average is so high, though, is because Auckland's population is so high. Remember before how I talked about how whatever happens to Auckland happens to the country because Auckland's a large part of our country, so whatever happens in Auckland skews the national data.
Do you have the data around migration figures that we had last week at our presentation on Wednesday?
There I do. Do you want me to pull them up?
Yeah, please.
So there's some really...
No, I thought I'd just ask if you had them.
So we're really lucky that people ask us to go ahead and do presentations. And Andrew and I were doing one. It was quite funny, really. We were doing it last Wednesday.
Wasn't that funny? It was in the middle of 2 other presentations for our clients.
Yeah, so we had an event on Tuesday. We had an event on Thursday. And so I came into the office and thought, I've got no idea what I'm going to talk about at this
other event I've said yes to. And then ropes his good friend Andrew into it as well.
Oh, you liked it, mate. You liked it. Let me just see, because this was actually quite good data, specifically about, I think I've got to find it. Let me just find
While
it.
he finds it, the biggest thing that we're curious about is migration figures. So as everyone probably knows, because we read the newspaper, a lot more people are coming into New Zealand as those that are leaving. Now, the people that are leaving leave from everywhere in the country. So you might have people leave from Nelson, Blenheim, Christchurch, Wellington, Auckland, everywhere. But when they come in, they predominantly go to Auckland. Now remember, there's also internal migration. So people from Auckland might move to Christchurch because it's cheaper. And I had this perception in my mind that people were moving to Christchurch because it's more affordable. Surely that's going to make the numbers of the population growth in Christchurch look pretty grand.
So this is only for 2023, not going forward. But what are we seeing? We're seeing people in Christchurch are having some babies, yep. And I've also got Selwyn District and Waimakariri. For anybody who's not living in Christchurch, these are like the neighbouring districts. So you can kind of think of Selwyn, I kind of think of it like Auckland's Pukekohe. Waimakariri would be like Christchurch's Auckland's Wellsford. So what are we seeing? We're seeing people having some babies. We're seeing a lot of international migration in Christchurch. But look at this. Isn't this fascinating? According to Infometrics, we're actually seeing more Kiwis leave Christchurch than come into Christchurch. And where are they going? We're seeing a lot of Kiwis move to Selwyn District and Waimakariri. So moving out of the city to some of these satellite towns. Now, we might still be seeing a lot of Aucklanders move to Christchurch, but we are seeing we're seeing more Kiwis leave Christchurch than move to Christchurch right now, according to Infometrics estimates. That is absolutely fascinating. We are seeing people out in Selwyn, they're having a good number of babies, almost as many as those in Christchurch, even though it's a much smaller region. We're seeing some international migration, but we're seeing a lot of people move there, a lot of Kiwis moving out to Selwyn and Waimakariri District. So that was just quite fascinating.
I've got a question that I'm going to answer. Are you doing the TV episodes you did a few years ago? Sorry, I forgot what it was called. The Deal. We had a number of developers being interviewed and what they're going to do as far as a project, and then you'd either take the deal or decline the deal. The exciting answer is yes. Do you want to talk more about that?
Yes, we are. Oh, The Deal. Yes.
We are.
I was reading some of the comments. We are bringing back The Deal. We are starting to film it. I think in May we're going to get kick-started. This is fascinating. It's Dragon's Den, if I can call it that, for New Zealand developers. And it's basically a fun way to try and educate you guys about how do you negotiate, what questions do you ask. And I actually couldn't believe how into it some of you got. I actually have a friend who was saying to his partner, who's one of my really good friends, Devin and Dan, and they're saying,
Devin loved it.
Come home quickly. We've got to watch The Deal. And I really like that. For you guys who are really into property, it's quite relevant for you guys. You guys like it, so that's wonderful.
And the best part is this year, developers are desperate to sell their property, so we're really going to get under their skin. So let us know who you want to see on there. Next question. Oh, someone asked the question, should I buy a 2 or a 3 bedroom townhouse?
Well, it depends where you are. And I tell you what.
You've got some data?
I might have a new tool. Let me just see if I can pull it up. This is either going to be an absolute fail or it is going to be the greatest thing to ever happen on a webinar.
Oh yeah, it is there.
So we have just built a new tool for our website. Now, it is not live yet, but I just got sent it from the developers. So you can get a good amount of data about who your tenants are from the census. But the trouble with the census is that they don't give it in an easy way that you guys can see. So Andrew, what is a suburb that we are interested in?
Sprayton.
That's a wonderful suggestion, Andrew. Oh, is it going to tell me? Did I spell it right?
No, you spelled it
Addington.
like you say it.
Here we go, Addington. Here we go. So if you pop this in here, Addington, we can see how many people are single families, how many people are single. So 30% of people in Addington are just single renters, right? And then we can see, well, are they couples? Are those people couples with children? Are they couples with one children? Here's where it gets cool for you guys, and I am so excited. So should I buy a 2 or 3 bedroom townhouse? Well, in Addington, 43% of renters rent 2 bedroom properties. So 43% of renter households go and rent out 2 bedroom properties. 1 bedrooms, that's about 20%. Other than that, 3 bedrooms. So if you are asking me, if I'm buying a townhouse in Addington, I'm buying a 2 bed. Now, if this was a different part of the country, and the really cool thing about this is you can add in a comparison suburb. You just have to pop in your email address. My email is edit@opuspartners.co.nz. So I'll just pop that in there now. Let's talk about Avondale in Auckland, because I think we'll probably get a different answer. I don't know that. I haven't tested this yet. Okay, cool. We've got a different answer. So in Addington, 2 bedroom properties are most popular. In Avondale in Auckland, 3 bedroom properties are the most popular. So if you were saying to me, Ed, what should I buy, a 2 or a 3 bedroom townhouse? Depends on your suburb. Totally depends on your suburb. We can also look at how many cars renters have. Look how both in Avondale and in Addington, 1 car households are the most popular type of households. How fascinating when we're thinking about how many car parks your house needs for your tenants, how much garage space you need. So I'm really excited about this because I've dug through the data, I've got it for you, I've spent ages waiting for the developers to build this. Hopefully within the next couple of weeks, this is going to be live on our website so you guys can just play around with it and get a sense of, well, what sort of property should you buy, or what sort of property property is appropriate for the suburb you're investing in.
Yeah, Weil is right. Now, one of the questions that someone asked before was, when does the 30% LVR or deposit requirement come in for existing investment properties? So if you buy a new build, you need a 20% deposit. If you buy an existing property, you currently need a 35% deposit. There's proposed change that will go to 30%, so 5% reduction.
Someone said, what a cool tool, Andrew, well done. You listen.
Thank you very much.
You listen to an hour and a quarter of the webinar, and I'm Ed.
Someone has to pay for it. So the answer is that will come in with DTIs. So we're expecting that about June, July this year.
Yeah. Hayley, you've asked the question, is that what people are renting or is it what people want to rent?
Great question.
That is what people are renting. Now, from an economics perspective, what people are renting is kind of the same thing as what people want to rent.
No, but I don't know.
Let me tell you the reason why.
Okay.
Because people might want to rent a 10-bedroom house, but if they're not willing to pay the rent, then it doesn't matter that you want a 10-bedroom house, your demand is for a 2-bedroom property. So when we think about demand, it's not just what you want, it's what do you want at a price you are willing to pay.
What happens if it's not there at the moment, though?
Well, if it's not there at the moment, that specific tool won't capture it. But how are you going to figure that out in any other way? So I appreciate your question, Hayley, because it's a genuine question. I like that. I don't have, it's not a survey of what tenants want. It's what they are actually renting as at the last census.
And I guess what you're trying to think is what might happen in the future. So if maybe you took a place like Rolleston, for example, where there's a lot of houses at the moment, that doesn't necessarily capture the fact that there might be a market for a 2-bedroom townhouse, but you want some more quantitative data around that. Greg Fisher said, CoreLogic believes house prices won't double in value in the next 30, like they have in the last 30 years, or at the speed. What do you think?
I totally agree. I don't think that house prices will go up in value at the same rate as they have in the past. So in the past, if you look from 1992 through to today, house prices in Auckland have gone up by 7% a year on average compounding. If you look everywhere else in the country, so New Zealand excluding Auckland, it's been about 6.2%. Now, we like to take a bit more of a conservative approach. We say 6% in Auckland, which is knock a percent off per year, which when compounding makes a massive difference. For the rest of the country, we kind of say 5% is pretty reasonable. And we just looked at some of the numbers on that recently on a podcast which we'll release over the next couple of years, over the next week or so, where you can see, why we've come to those assumptions and are they realistic. But am I betting on the fact that house prices will double in exactly the same time as they have in the past? No, because we actually have seen it slow down. It's gone from about 7 years in some cases. In fact, house prices doubled between about, I think it was 1980 and 1984. I'm pretty sure house prices doubled within like 4 years. Then it's been 8 years, then it's been 10 years, then it was 11 years, then it's been 12 years. So it has been lengthening out. We expect that trend to continue. And so we don't think it's going to keep going up at 7% per year in Auckland or 6.2% a year for everywhere else in the country.
Someone asked the question, do we know for certain that the Bright Line is going to be applied retrospectively?
Yes, because that's what the government said.
Yeah, and the next question is, I want to add to that. So at the moment, it's about contract date. What do you understand it to be moving forward?
I expect it will continue to be contract date, unless we get new guidance out from the IRD. So I'll see what happens once the IRD releases that guidance.
Yeah, and so what that means is you've got to be really careful that you don't go selling something and think, well, my sale date has occurred on X date, and then you get captured because you signed it up 2 months prior, and therefore you fall into that Bright Line window. There's going to be a bit of a risk period that you really want to make sure you get accounting advice. Otherwise, you might get caught by that, and once you're caught by it, you're paying that tax.
So I've seen another interesting question. What's the impact of taxes or commercial rates for properties for Airbnb rather than longer term tenants? Are there any new rules we should be aware of? The answer is absolutely yes. And the big one you need to think about is the app tax. So what the app tax is, you would have seen that on in the media at the moment. For people who are renting their property out for Airbnb, you are going to face a bit of a tax. Now, Airbnb is going to handle the calculations for you, but effectively it's a 6% decrease in your revenue. So if you are renting a property out for $200 a night currently, it's going to be about a $12 reduction in the amount of money you actually get in your hand per night. And there are some technical reasons for that. We've got a podcast about it if you really want to dig in, but that's going to be the main one that hits Airbnb owners over the next wee while. I wouldn't call it a new rule, but what I would say is that we are seeing councils start to pick up more on people who should be paying commercial rates but aren't. So down here in Christchurch, the local council is now saying you need to have a consent to rent your property out as an Airbnb. Our understanding is they are just starting to enforce that more. In the past couple of years, the councils have not enforced the rules they have for Airbnb owners. So Airbnb owners primarily do need to pay commercial rates depending on how long you're renting it out for or how many nights per year you're renting it out for. But the councils have not enforced their rules very well. We're starting to see more enforcement come in. So it's not a new rule, but you might start to see the environment start to change. What else are you seeing right now,
I'm
Andrew?
losing my voice.
Yay!
Is the tax rate on trust income going to change? I wouldn't bet on it anytime soon. Is my
Yes,
answer.
it is. It is changing.
No, sorry, it's changing to 39%. But I think what they are asking is, will it come down?
Oh, will it come down?
Yeah,
I don't think
I
so,
would
no.
not bet on that.
The other question that's coming up is, I don't know, I just said that and then didn't have anything lined up as the answer. Stephanie's asked a great question. How is the app tax going to be collected? It's going to be collected by Airbnb, but it is also going to be collected by Book a Batch, or it's also going to be collected by whatever short-term stay accommodation you use. So if you're in Christchurch, you might use Christchurch Holiday Homes, which is actually run by Sue Harrison, who's the president of the New Zealand Property Investors Federation. So any of those platforms will collect the app tax for you. It's a portion of the GST collected, which is now going to be passed back to the IRD. So that's how it's going to come. Mike is correct, 10% of trusts come under the income cap. So sorry, let me just say that a bit better. So what he was saying is only a small number of trusts are going to pay the higher tax rate, so 39% tax rate on any income earned. For some property investors, you're not going to be captured by it, or you might not be captured by it if you've got one property in there with not that much cash flow. That's absolutely true. For anybody with shares or dividends that come into the trust, you're probably going to be captured.
Sky said, going back to Brightline, if we purchased a new build property in October 2022, and by that they mean signed on it, and we're due to settle the end of March, would our Brightline date come from October or March? Our understanding...
No, it is. It's October 2022.
Yeah, okay, but you would still wait till the legislation's passed.
I would always wait till the guidance comes out from the IRD.
Yes.
But right now, like if you're holding on to the property, the answer is it's
Well, they haven't settled it yet.
Well, it's based on the contract signing date.
Yeah.
That's what everything from the IRD has come out. They might change the rules, who knows? But that is what it is.
Yes, but I'd recommend in this time where it's going to be a bit grey for some people, check with your accountant.
So one other question that's just come up to me is, do you know what number podcast that Airbnb episode is? Sorry for the lame question. Well, do you know what? That's such a good question. Do you know what I do,
Show
Jim?
us.
Oh, what I come up with all the time. So I often just go to Google and I go,
No.
Opus Partners. No, I'm going to do it. Opus Partners.
Don't you use our search function?
Airbnb GST. Here we go. Airbnb tax changes. What the app tax means. Here we go. Yeah. I always do this because sometimes our search function bugs out. I've got the it bugs out. So I've got the developers try to work on it. But there we go. Episode 1562. You can also use our search function up here. So if you go Airbnb tax and then search for podcasts, it should come up as well. That will search our website. Sometimes the search function doesn't work very well, and so you might need to just Google. I often just Google because I'm lazy.
One last thing, because you want to go on a date tonight and go for dinner since Angela's not here. Show us the DTI calculator.
Oh, yes, let me just find it. So I go to Google and I go to... No. We actually, this one's interesting. So we released this as part of private property. So if you guys don't know already, we have a weekly email where Andrew sends out a whole heap of interesting things about what's happening in the property market, and we call it private property. Now, one of the interesting ones, or best ones, was what?
What do you mean, one of the interesting ones? I work very hard on this every week.
Yes, I'm sure you work very hard on it every week. Number 93, there is a really cool calculator down here where you can say how much do you borrow, can you borrow under the new DTI rules. So let's say Andrew and I, we're now in a couple. And we
Sorry, Angela, that was short-lived.
And so, wasn't that short-lived? So me and my partner's income is $150,000. Andrew and I earn 75 grand a year each. We currently have one rental property. We're rented out for $550 a week. We've currently got total mortgages of, let's call it $500K a week.
Not a lot.
No, let's call it $600.
Good old double income, no kids.
And let's say we've got no other debt. I don't know, I just wanted to quickly come up. Yeah. So this tells me, under the new rules, we can borrow up to $949,000 for our next investment property. Our current DTI is 4 times. But of course, the reason this might look a bit higher than just taking our income and multiplying it by 7 is, of course, because when we buy a property, we get some rental income. So there are some really nerdy calculations that go on in the background to try and give you these rules. I spent a lot of time doing basic algebra to try and make these calculators.
Where did people find that?
That is, if you go
Private property number 97, was it?
No, it was private property number 93. So if you go to...
oh, you're so smug.
Yeah, I know. Private property issue 93, hashtag 93, you'll find that there. And while you're there, check out our learning section. God, this is a good learning section.
That's right. We've put out so much content that now we've made sure everything's on our website. And it's amazing how much stuff there is now.
Yeah, so you've got videos, you've got podcasts, you've got more podcasts, you've got articles, and you can search these things and say, you know what, I want things about tax that are podcasts, and hopefully if they're tagged correctly, something will come up.
Someone asked a question about ring fencing before, so type in ring fencing, see what we come up with. Yeah,
okay.
You're hoping it works now.
There we go. Well, I imagine it would be very embarrassing if it doesn't work.
No, embarrassing for you, because that's your job.
Let's just type in ring and see what happens.
No, you've still got tax selected.
Yeah. Ring fencing, what property investors need to know, what ring fencing means.
So someone asked about whether or not you could offset your losses against your income. You want to type the word ring fencing because that's what it was called, and listen to those episodes.
Fantastic. Let's wrap it up there. But of course, please don't forget to rate, review, and subscribe to. That's the podcast. That's the podcast. Thank you so much for being here tonight. We really appreciate it. Come back next month. We're going to be talking about something else at Property Live. Tune into the podcast. Tune into the YouTube videos. Read the articles. If you haven't got enough of us yet, we'll see you guys soon. Thanks so much for being part of the community. Bye now.